שלום חברים, וובינר חודש נובמבר 2025, והיום I'm excited to introduce Isaac. I found him on Facebook. We had a very good conversation through the phone. He told me a lot about his family, about multi-million transaction that his family is doing. Is like the fourth or fifth generation that are still doing real estate in high volume transaction in the United States, and he's going to tell us everything about it. Okay, and we are excited to hear and maybe learn some new things. So, Isaac,
Yes, thank
go for
you.
it.
Thank you, Michael, so much here. I'm going to share my screen real quick. I'll move you guys to the side. So let me share my screen. Can everyone see
We
my
can see
screen?
the screen. Yeah, we can see the
Okay.
screen.
Okay, perfect. Well, first of all, thank you, Michael, for this opportunity. I'm very excited to teach you guys and give you guys a little insight about commercial real estate. So, Michael told me not to hold anything back and just give you guys it all. So, please come with any questions that you guys have, pen, paper, take some notes. I am going to go through a lot. I know we only have a few minutes or an hour, so I'm going to do my best to get through everything and answer all your questions.
Limit, Isaac, no time limit. Feel
No
free.
time limit. Then we're good. Then let's get after
Yeah.
it. Let's jump into it. So, for this presentation, I'm going to give you an introduction to Lifestyle Ventures, give us your bio and operation information and credentials. Then I'm going to go and talk about different types of commercial real estate, the difference between residential and commercial real estate, and then we're going to do a deeper dive into commercial properties. I'm also going to show you guys a few of things that we've done, what we're doing, give you a little back end and how we structure things. And then we'll get right into it. So, Lifestyle Ventures, like Michael was saying, we are a family business. So it's Kobe, Isaac, and Ephraim and I. We have over 30 plus years of combined experience in residential and commercial experience in private lending, large rental portfolios, developments, renovations, property, and project management. Currently, we have 10 million plus of assets under management. And from 1997 to today, Lifestyles built, bought, and sold 300 million plus worth of properties for a profit. And we are experts at structuring big real estate deals using private money partners and self-directed retirement accounts like IRAs. Okay? So before I wanted to jump in, commercial real estate has a lot of terminology, and I think it's important that you guys just know a few of them. You might be familiar with it, but I thought we'd go over it. It's something super important to know when getting into the commercial real estate aspect and investing. So guys should know these terminologies, super important. Net operating income, or NOI, is your income from rent and other revenue minus operating expenses. And this is before debt. So before you pay your mortgage payments, that is your NOI. And this is super important number to know in commercial real estate, as well as cap rate or your capitalization rate. That is basically your NOI divided by your purchase price. And it's presented in a percentage. So it helps compare properties and understand market prices. Those two things are probably the most important when it comes to commercial real estate. So those two are, you guys got to know that. And what's nice about, cap rate and NOI, I'm going to go deeper into it on the other slides, mainly those two. So I'll help you understand it a little deeper. Now, other ones, when it comes to commercial real estate, you usually do have investors or are dealing with investors, and it's also good as an investor to know these. So, a cash on cash is basically your annual pre-tax cash flow divided by your initial investment. So, it basically just tells you your return you're getting on your money you invested. Same with IRR, but it's a little more in depth, right? So, your internal rate of return is your IRR, and it's your average annualized return over the life of the investment. So it's your cash flow, refinance money, all of that, all into one. It's a little more complex. We're not going to go over those, but it's just super important to understand that. Same as equity multiple here at number five. It's your total return divided by initial investment. So it's like cash on cash, but it just tells you how much you've made on your money. So if you have a 2x multiple, it's double your money. And then your break even occupancy, it's basically something as an investor you should know when you're underwriting a deal is, okay, what occupancy rate do I need that will cover all expenses and debt and I'm not bleeding? So it's something you guys should know. So why don't we just hop right into it? So there's different types of commercial real estate. You have office, retail, and industrial. You have multifamily, condominiums or condos, and hotels. So usually the customers you have in office and retail and industrial is businesses. With multifamily, condos, and hotels, it's usually individuals. Your lease types are different. So with office, retail, and industrial, it's a long-term leases. They could be several years, up to 30 plus years. And details vary. So some, leases will be very different between the two and different clients or tenants you might have. With multifamily, it's more on the medium size. You're around 1 year. You could go more, but the average is around 1 year, and it's very similar leases. With condos, the business plan with that is you want to develop it and pre-sell the units. So you're not really going to have any leases there. So it's mainly an ownership. And then with hotels, it's very short. It's 1 day, few days, and it's very, very similar terms as well. Now, with the timing of lease and sale, for office, retail, industrial, multifamily, and hotel, you do that after you build, or there's already an existing building there, right? So with office, retail, multifamily, and hotels, you usually lease or sell once it's already built out or you're acquiring. With condominiums, like I said, you're doing that pre-sale. And then the purpose is you have businesses with office, retail, and industrial, so it's a different type of tenant. And with multifamily, condos, and hotels, it's usually residential. Hotels can be business as well. So there's also different business models when it comes to this. So with office, multifamily, and hotels, you usually develop and sell upon completion. With condominiums, like I said, it's all about pre-sale. So that's why it kind of would work, but you mainly wouldn't do that. When it comes to developing pre-sale, like I was saying, before completion, it only works with condominiums. You wouldn't see that in hotel, multifamily, or office. Then when you acquire an existing and do nothing to it, it's just a turnkey cash flow. That works with office, retail, industrial, multifamily. Obviously, condominiums, no. And hotels, you wouldn't get the best returns with that. And it's the same with acquiring existing and then renovating. That works with office, retail, multifamily, hotels. Again, not condominiums. Any questions about that piece or anything I got, or we're good to go?
Yeah, regarding the condominium, the purpose is like to sell or to hold. Like why you cannot just build a condominium and just hold it?
Yeah, so with condominiums, condos, the business plan usually is you're selling each unit. So let's say I'm building a 5-story condo and there's 100 units, let's just say, to make it easy. So what you would do is while you're building it, and even before you build it, you're pre-selling and you're selling each unit one by one. That's usually the business plan with condos. With multifamily, that's where you would hold on to it. But with condos, it's that business model, it makes more sense to just pre-sell it. And it's a great business idea. Yeah.
It's much more similar to multifamily can be condominium, like regarding definition, it can be condominium, but the end result is different. In multifamily, you holding, in condominium, you just build to sell.
Yes, you're building to sell and you're selling each unit. So condo, it is the same. It's exactly the same. It can be multiple units. With multifamily, usually the units are smaller, like the square feet. While with condos, it's like really nice, really big. So that's why you would sell it. It makes more sense because the size is bigger. It's harder to rent out. I'm not saying it's impossible, but it's more of a home, if that makes
How
sense.
do you determine where if either sell or either hold it?
For condos,
Yeah, like let's say you have a lot and you're about to build, 20 stories of a building. And when do you decide, hey, I'm going to sell it, or hey, I'm going to hold it as a multifamily?
oh, that's a great question. Well, that really depends on your business model and how you like to operate. So obviously, it all comes down to the numbers, right? So me personally, I like long term. I'm a long term holder. That's what I like to do. Have I done transactional stuff? Most definitely. So it really depends on the market I'm in and what would be absorbed more. So for instance, like let's say I'm in an area and there's not that many renters out there. And I've noticed when I'm doing my research that it's harder to rent smaller units. So when I look at that, I'm like, okay, maybe I would want to go to the condominium, like the condo style, because one, I know the market will absorb it better. Like people would rather buy it because I'm looking for speed when it comes to that. Same with multifamily. I want to make sure I can rent out all my units and hold it. You could also, with multifamily, it could be a business plan to even stabilize it, right? You build it, you rent it out, you stabilize it, and then sell it. So it really just depends on your appetite and what type of business model you want. With condominiums, you'll probably get more profit, but it's short term, right? You're once you sell it, you're done. You have to get out. You're not getting that long term cash flow. It's very transactional.
Okay.
All right. Any other questions before we move on? Awesome. So, and this is exactly what we were just talking about. You got to find your business model, right? What is your business model? There's usually three to four. One is distressed or to develop, right? And a distressed property is a complete like gut. It is usually, not the best location either, but it's a lot of risk, but there is a lot of return. The sweet spot would probably be the next one, which is value add. A value add is basically just renovating. So you buy a property, it's undervalued, it's a bit distressed, but it's in a good market, it's C to B class, and you basically renovate it, force appreciation, and then now you make it into more of a B, A class building. It's nicer. There's a lot of upside in that and a little less risk, but there's still risk. And then you have turnkey. Turnkey is you buy a brand new building or something that's already renovated. There's not that many issues. It's already cash flowing. It's in usually a better market. The only thing with that, you're not getting the most money out of it. You're not really forcing appreciation. It's more of just cash flow. So no business plan and no investment is wrong. It just depends on what is ideal for you guys. What makes sense for you? Are you just want that passive income, less returns, or are you looking for more of that juice with a little more risk?
In
Okay.
this market, in the current market, do you see enough cash flow by holding properties? I'm assuming you're using leverage. It's not like all cash transactions. Do you see any cash flow in holding multifamilies?
For turnkey or just in general?
Let's say you found a deal that is a value add and you renovate it and you took a loan and then you refinance it and you are holding it as an investment property. Do you see enough cash flow? So enough cash flow is something that can be deferred by different investors. But let's say I don't know, around two to 500 for a unit. It's something that makes sense with your type of investment.
Well, that's actually a great question. Right now, the market is a bit different. It is a bit tough, especially just to even pencil out something that does make sense to refinance it and get money where it does cash flow. So you want it for us, what I like to be in the green. I like to at least have some cash flow um, to where it makes sense for me to even hold it. Now
Please,
that it
can
does,
you refer a number, please? What some means? Like for me, below $200, it's a good deal, but not the best. I prefer to be around $400 to $500 a unit with 5.5 to 6.5 interest rate.
yeah,
Uh, I'm finding myself around two to 400 a unit in cash flow. What is your bottom line, or where are you aiming to and say, hey, this is a good deal? Or you can measure it regarding how much the deal is doing for you regarding cash on cash and ROI.
yeah. So exactly that. I'm kind of in the same boat. Now it does depend on where it's located, what type of unit it is. Um, if I'm getting 250 per unit, it's not the best, but it's not something where I'm like, okay, as long as it's paying everything and it's net free, like it's cash flow in my pocket, I'll usually hold on to it. But it really depends on the location. If I'm not 100% like I don't love the location, then I'd probably get out of it. But if I was able to get really good returns and then decent cash flow, I'd still probably hold it. So around that number, obviously the more the merrier. With commercial real estate, it is harder to find those bigger numbers. It's just because you're so many units. Like it's especially multifamily, for instance. If you're getting cash flow, obviously you want as much as you can, but it's so many units, so it does kind of balance it out. It's something where I want to be in the green. I never want to bleed after I already did my completion. I did my renovation. I stabilized the property. I went and refinanced it. If I can't pay off my investors and my loan at the beginning and still have some cash flow, I would just sell it. That would be the difference. So every deal is a bit different, but that's kind of where I'm at.
Cash on cash and ROI, like a specific number that you're aiming to?
Yeah, so obviously, and everyone's different, right? But we like to aim in the double digits. So if we can get a cash on cash in the tens and up, that's ideal. And RRI, IRR, sorry, we want to be around 20 to 25%. That's for our investors. So when I'm presenting a deal, those are the numbers I would like to be at. I would like to be, I want my investors to at least have a 10 and up cash on cash, and I want to have their IRR to at least be in the 20s to 25%. That's a very good number, especially in the real estate investing world. Obviously, if you can get more, that's what you want. But conservatively, if I can get in that number range, that's ideal. And investors like that. That's a good number.
Okay.
So now I'm going to kind of give you a little the difference between residential and commercial, right? So I'll start with the residential here on the left. With residential, the valuation is based on comps. So, for instance, let's say you have a neighborhood and every house there is selling or sold for $1 million. I can't have a house in that same neighborhood, maybe even with an extra bedroom and a little more square foot. I can't ask for $5 million. It won't sell. It's that's not what the market will absorb. You're comp based. All right. Even even if I buy a property in that neighborhood for $500,000, I renovate it, I make it brand new. I know my ARV is still going to be $1 million. I'm not going to underwrite it and be like, hey, I'm going to get $5 million for that deal. It's very comp based. So, and with lease terms, you're getting around 6 to 12 months. You could go more, you could go less. Usually you're around 12, 1 year. Tenant types are individuals and families. Management's more hands-on and local. Appreciation again is market driven. So, like I said, if you're buying in a 500 and you know you can force the appreciation and do the renovations, you're still capped at what the market's going to let you do. And scalability, it is limited, but you can scale it. It's a little different. It's just harder. Like if you're buying one house at a time, you're very limited of how fast you can scale. But obviously, I mean, you could buy a portfolio with 100 single family houses on it. So that's a little on that side. Now with commercial real estate, the valuation is based on NOI, the net operating income, and cap rate. That is, and I'm going to go really deep on that part for you guys because that is going to be that is the creme of the creme when it comes to commercial real estate. So it's based on NOI and cap rate. It's not based on comps. So I can have a building, same vintage, right next door. But if my building is performing better, my building's worth more than that one. Okay, and I'll go deeper into that on the next slide. Lease terms are around 1 to 30 plus years, depending what you have. I mean, obviously for multifamily, it's around that 1 to 2 years, just like residential, could be 6 months. But office, retail, industrial can go all the way up to 30 plus years. Tenant types are around are businesses and multiple households, depending if it's multifamily or not. Management's a little more professional or scalable. It can also be hands-on if you are fully integrated and have your own management company, but it's usually you hire a third-party management company. And appreciation is, like I say, is income driven. It's at NOI and cap rate. So you're really able to force appreciation with commercial real estate, and scalability is really high. Like for multifamily, an instance, if I buy one apartment complex that has 100 doors, just like that, I have 100 units. And then I could go buy another one that has 70 and then more. So it's one purchase can get you a lot more. So it's easier to scale as well with retail. Like, okay, I have 30,000 square feet, or I can go buy one 100,000 square feet. It scales. Now, what I'm going to talk about next, let's say you don't listen to this entire thing, this entire presentation. You don't hear anything I'm saying. This is the most important part. I would get a piece of paper out. I'd take notes. This is what it's about. You can forget everything else I say, but this is the most important. So in commercial real estate, your valuation is your NOI divided by cap rate. So I'm going to give you an example, and I apologize if I'm speaking too fast. Let me know. So let's say I have a property and the NOI is $1.5 million. That's revenue minus expenses. I have $1.5 million. And let's say in this area, the cap rate is 5%. So I take 1.5 million divided by 5%, which is 0.05. The value of my building is $30 million. Okay? So let's say I increase my NOI by $50,000 at a 5 cap. Do you guys know what that'd be? So if I take $50,000 divided by 0.05, that's $1 million. So just like that, and let's say I don't even bump up my rents. Let's say I just save on expenses $50,000 in 1 year. At a 5 cap, I just made my building worth $1 million. More. That is the power of commercial real estate, just right there. I could save 50,000, not even bump rents. Obviously, when you do both, it bumps up. That is why commercial real estate is so powerful. You cannot do that in residential. I love residential. It's a great business model. But when it comes to commercial, this is where it is so exciting because that's where it gets really fun. However, now let's do that same example, right? So let's say I have $50,000 divided by a 6 cap. That's 833. So that's a difference, right? Your cap rate is very important. So when it comes to cap rate, it's really market based. So New York, for instance, will have a very low cap rate. And a cap rate, to kind of give you a better idea, is basically the percentage of money you're getting back. So if I invest $1 million and the building's a 5 cap, I'm getting 5% on my money, right? If it's a higher cap rate, I'm getting more. So when you're going into commercial real estate, when you're buying, you want to buy at a high cap rate, but you want to sell at a low cap rate. You want to sell it to someone who's willing to get less on their money because that's where your valuation is going higher. So it really depends on you. I mean, you could sell your building for a four cap. You can sell it for a five cap, six cap, seven. But it's also about your market. So if I'm in Ohio and all it's usually around a six cap, it'd be really hard to even push for a five cap. You could probably get it. There's investors that would pay, but it'd be a lot harder to actually get it, especially when it comes to bank financing. Because your bank, your mortgage broker, banks, they'll know what their cap rate is in that area. They're seeing what buildings are going for. So they're not going to give you 5% on cap rate for a refinance because they know they're like, no, 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 absolutely not. So that is super important. Is there any questions on that piece? And I'll do a little case study right after this so you can see how
No,
we
that
did.
is great. Great information. It's something that I'm teaching them all the time, the differences, and it's very important to indicate that residential is 1 to 4 unit and commercial starts from 5 units and above. So, yeah, I'm teaching them the same thing all the time, and
That's
we will be
awesome.
happy to see a case study of a real numbers that your guys, your company are doing just to learn a little bit more.
Yeah. So let's
Yeah,
jump.
Isaac, I have a question.
Yes.
If you said if you're adding $50,000 to your NOI, right, at a 5% cap, but once you're changing your NOI, you're also changing your cap.
It depends. Okay, yes, depending how you're looking at it, right? That's a great question. So in that case, when you're looking at the value, right, you can change your cap, like how we were talking about cap rates here, right? It's your NOI divided by your purchase price. So that's kind of where it's at. Let me see where I was at. With that, when you're not really changing your cap rate because it's mainly market. So when I'm going to a bank and I'm asking, hey, I want to refinance on my property, and they know the market is around a six cap, then my cap rate doesn't really change. Depending, it can. Obviously, I could buy it at a seven cap, and then I refinance at a five cap. But it's not really going to jump too much. Did that make sense, or do you want me to explain a little different?
No, it didn't
Friends,
because
yeah.
a cap rate is a derivative of NOI, like you're saying. So once you, let's suppose you said you just lowered your expenses, you changed your NOI, so your cap rate, the calculation is based on your NOI. So that's what confusing to me.
Yeah, okay. So there's two. Great point. And I'll clear it up. I'll clear it up. So when you're looking at the property itself and you're analyzing it, then yes, the cap rate is different. But when you're going to refinance or sell, it doesn't really change. It can, but it depends on you and how much you want to do it for. So, for instance, because you can go sell your property for however much cap you want at a different cap rate. But when you're doing your calculation, like you just said, yes, then your cap rate changes. But if you want to refinance or sell the property, you go by the market cap or what you think. Because a buyer will buy it for, let's say you increase your NOI, right? You could sell it at a four cap. If someone is willing to buy it at a four cap, you can sell it at a four cap. It does not matter. That's not going to change. Same with banks. If you increase your NOI and you know you're at a six cap, the market, you know, banks are giving loans at a 6% capitalization rate, then that's not going to change anything. But when you're looking at the value, so it's like, I know, okay, it's $30 million dollars and my NOI is 1.5. Okay, that is a cap rate of five. That is my cap rate. But when you're going to sell it or go get a refi, it's not up to you, but it is up to you for how much you're able to get it at. It's not going to change. If you get more NOI, it's not going to make your cap rate go higher. It can, but it's not like when you're going to sell it, you can still sell it at a five or a six, but that also depends if people are willing to buy it at a five or a six. Did that
That
make sense?
makes sense. Let me clarify that because if you're going to try to sell it in NOI of 2 million, so you take the 2 million and divide it by 5% cap rate, so the value goes up. The cap rate still stays as a stable number.
Yes.
Okay, because the bank is referring to the cap rate of the area and it's very conservative. The cap rate of how much you can sell it, maybe a private investor will be happy to purchase it in 5%. Maybe another a group of investors will look to purchase it in 8%, and that change the values also.
Yes.
But if you take a look only on the NOI and you are proving the NOI, meaning the value of your building going up, and the cap rate still stays stable on 5% because it's very conservative regarding financing through the bank. What the market will tell you, it's something else. Somebody will tell you, hey, I can pay only up to 7% cap rate, so lower your price. Or somebody else will tell you, hey, I will be happy to purchase it in 4% because this house or this multifamily cash flowing so good, the area is A plus plus plus, and I will be happy to purchase it in this cap rate and makes sense for me. But in now interest rates, and correct me if I'm wrong, Isaac, when you take commercial loan in 7 or 8 or maybe 9%, purchasing a multifamily in 5% cap rate doesn't really cash flow.
Correct.
So the market is directing you to purchase multifamily in a higher cap rate than your interest rates when you are trying to finance the building. This is part of the game because without leveraging, like you cannot maximize your returns, your yields.
100%. And I want to add to that, and that was perfectly said. I also want to add now, this is super high level, and it's not really that important, but when it comes to refinancing, banks usually will go a little lower. Nah, it depends. Like he was saying, like Michael was saying, with interest rates in the markets, they might not. But banks will most likely give you a refinance at a lower cap rate than what you're actually able to sell it at. Because what Michael was saying, like it depends on the person, and people would rather want a cash flow, so you're not going to be able to sell it at a super low. But banks, they're not buying the property. They want to see the numbers. If the numbers make sense to them, they'll still refi. So if I'm able to refi at a 5, but realistically I can only sell it at a 6, that's okay. You got to look at both options. But yeah, perfectly worded, Michael. Um, any other questions, comments, concerns before we move on to a deeper dive of the NOI, but like with a case study? Mayor, did that make sense to you? Is everything
Yeah,
everything
Mauro is a mortgage broker, so he's
okay?
into
So
numbers.
Yeah. I mean, it made sense. It's just, and always when I'm talking to clients, it's like always like the chicken and the egg. What makes more sense, the NOI or the cap rate? What determines what when you want to sell or you want to refinance? But that's okay. Let's move forward. Let's look at a numeric example. That will make more sense, and maybe that'll make things a bit more in order.
okay,
Clear.
let's do it. Okay, so this one was back in 2020. It was a 296 units. I know we're staying with residential, and I said we're going to do commercial, but this is just a residential. So we're
This
going to
is something that your company purchased.
we partnered with the team, but yes. But this is back in 2020. This is an example deal for you guys. This is not
Okay.
a live deal. So this was back in 2020. So yeah, and with these bigger deals, we like to partner with people. So because obviously you'll see why it's a lot of numbers. But that's the power of commercial real estate. You find partners and you can do a lot and scale a lot more. So here's the current financials. On the left was when we bought the property, right? So it's 296 units. They were 87% occupied. Their rental income, vacancy, and other income added to around 2 million in gross income. Their expenses were around 1.4 million. Okay? That's taxes, insurance, utilities, maintenance, payroll, management. So their net operating income was around 644. which is a 68.5% expense ratio. Now, one thing with value add multifamily, and I'm just speaking about value add multifamily, your expense ratio should be around 50%. So when you're also buying or looking to acquire a multifamily and they're saying, oh, it's only a 30% expense ratio and it's a value add deal, that's a red flag. You should have that as a red flag.
Can you dive into it? Expense ratio, what you divided by what in order to get this number?
Yes. So what you're doing, you're dividing your expenses with your income.
Okay.
Your expense, and it comes out as in a percentage. So you would
the percentage is high, meaning the percentage is too high to refer it as a good deal. Like you prefer to be around 50% or lower.
No. So yes. But what's good, so remember, this is a value add deal. So when you go into a value add deal, you got to know you're getting into a distress that shouldn't scare you. A high expense ratio and a low occupancy, it's terrible numbers because when you acquire the property, you're going to be bleeding day one. It's going to be hurting. But remember, your point is to force appreciation and add value. So that shouldn't scare you. That actually is very good because then you know, okay, if I come in, I normalize expenses and I up my revenue, I'm going to bring expenses back to around 50%. So it shouldn't scare you. But when you're looking at deals, 50% is average. And just understand for you, when you're underwriting, you're going to be around 50%. So don't be very aggressive with your underwriting. Be like, oh, I can get it to 30%. You're most likely not. And if you don't get that, that means your numbers are going to be off, meaning you're not going to hit your quota or your pro forma. So you want to be very conservative. 50%, very conservative. It's usually very average. What I'm seeing with our properties and when I do stuff, it's usually around 50. But when you're looking for a property, don't be scared that their expense ratio is 70% and their occupancy is super low. That could be a huge opportunity right there. Just understand and realize, okay, when I'm getting in, I'm going to be bleeding at the beginning, first year. So just have capital raised for that. Have reserve money. So when you are bleeding, you're able to still pay off and grow at the same time. So, and I'll go a little deeper into that. But to show you, this is what our pro forma was. So we were projecting in 42 months, after we do our repairs, our rental and other income plus vacancy, we can get a gross income around 3.3 million. And our expenses around 1.6.
The rental income, how did you do that? Because one of the difficulties I'm finding in multifamily, in order to raise the rent or rental, okay, you have to make some repairs or, make them more livable or better kitchen, better bathroom, better flooring. People, there is a reason for them to pay you more. How do you leverage the quality of the units while people are occupied the building? 87% is a lot.
Yeah.
Are you forcing them to get out? Because I saw in a lot of case studies that they are forcing them out. They tell me, hey, next month the rent will be from 1,000, 2,000. If you don't like it, move out. Like after people are moving out, they are renovating everything and make the quality of the units be much better. What can help them to rent it in a higher rental?
Yeah, so that's basically it. You kind of just hit it on the nail. Now, this is also
you forcing them out.
So you can force, but what you do is basically you raise the rents and you're like, hey, your renewal, new management. The day one you get in, day one, you're giving flyers out. You let everyone know there's new management. Just like that, usually a lot of people leave. Now, because some people don't like change, but then you do tell them, it's like, hey, we're raising rents to X amount at zero capex, no renovation, nothing. Rents are going up to this. Because usually when you're buying a property, a value add property, the rents are below market. So you want to at least get it to market. So you're like, hey, rents are going to be this price. And it could be the price of after repair value, even if it's not repaired. Some people will stay and some people will leave. And then once you do that, you go ahead. But you're not, but remember, you're coming in with leases. It's a lot of property. So leases can be in a year from now, ending in a year from now. They could renew in half a year. So what you do is to make it not where you don't kick out. Everyone has different plans. This is how we do it, right? Whatever we fix up the common area, we do any exterior work, we do better management, put high tech, new tech in there, make things more efficient. We go in, we clean up the driveway, reseal it, restripe it. We're giving the outside more of a facelift, if you will. They'll see management's better. And any units that are already, they're not occupied, they're vacant, we'll go and renovate them, depending how bad they need it. Some need hard full turns where you're doing everything, new kitchen, bath, flooring, paint, while some just need, okay, maybe you polish up the bathroom, you repaint, maybe new flooring, but you don't have to do like a full hard turn. And then while you're doing that, one, people will be like, okay, I see there's improvements. You re-renovate, and then you could be like, hey, I have two options for you. I have a new renovated unit. You can move there for that price, or you can stay here for the new price, the renewal price. So you're giving them options, right? You're not just kicking them out. You want to show them that there's
So how many left in this case? How many left after you announced that you're going to raise rental?
So when we did this one, there was 39 units vacant when we got there. So there was 39 vacant, 30 of them needed hard turns, and 9 were like half turns. So a big chunk actually do leave. I mean, you can go all the way down. You can go down to 70, 60% vacancy, right? But that's what you got to understand and counter when you're writing that. You should expect that. So we're not afraid of that. That's something we expect because
to raise value, you need to renovate. And if 70% are living, it's giving you more opportunities just to leverage the quality of the units and ask for more.
Yes, exactly. And you also got to understand, guys, when it comes to commercial real estate, especially with these bigger units, things take a lot of time. With residential, it's very quick, very transactional. I mean, you can buy a house very quick. With this, it can take 3 months just to buy the property, just to close on it. So when you're doing a renovation and you're looking for value add, you're looking at 3 to 4 years before you stabilize it. So just understand that nothing's going to happen overnight. It's not going to happen in the first year. You're going to bleed. Sometimes you don't bleed, but just expect it because because it takes a long time. It's not. That's the thing with commercial real estate. It's very long term. All right. So with this, and that's a great question, Michael. And anytime you guys have questions, please. So once we were able to bump up the rents and have lower vacancy, we get around 3.3 million. And our expenses were around 1.6. So another thing I want to bring up is even though you can normalize expenses, taxes and insurance are always going to go up. Just expect that when it comes to commercial real estate and when you're doing your underwriting. Taxes being the most important because there's times where the state or the county, the city, they're going to reassess your taxes. And you have to find out by how much do they reassess and how often. Because if I'm like, oh, okay, taxes are going to stay the same, but I know they reassess every 2 years and I didn't account for that, your numbers will be completely off. That's super high level and we can go deeper into that because there's the whole thing about taxes. But just understand taxes and insurance always go up. However, you can normalize your utilities, your maintenance, your payroll, management. So we were able to get around 1.6 million. Okay? That was our NOI, 1.6 million. So we're back to our expense ratio around 50%. Remember, that's expenses divided by your income. That's your expense ratio. So just remember that 1.6 number. And this is where we're going to go back to that NOI and cap rate. So here on the right, where it says stabilized projections, our NOI is 1.6. At a 6 cap, our valuation, the property is valued at 27.6 million. Okay? So that's 1.6 divided by 0.06. That's a $27.6 million valuation. Now, so we bought it here on the left, we purchased it for 16.3 million.
Wow.
We had a renovation budget of 2.5, an acquisition of around 320,000, closing and legal costs around 460,000, and operating capital around 450. So we were all in for 20.1 million. Now the sources where we got the money, the bank gave us 12.2. The bank also gave us rehab loans of 2.5. And then we had a raise from investors, 5.3 million. Now, this is also a high level.
You improve it in 33%, literally 33% value add.
Yeah.
From 20 million to 27.
Yeah. And also, this is something, guys, you should really think about when it comes to evaluating and looking at commercial real estate, especially value add deals. So, right, the valuation is 27.6. So we go to a bank, an agency loan, like Fannie and Freddie Mac, permanent financing. And we go, hey, we want 75%. We want a refi. So 75% of that is 20.7 million. And that's in 42 months, right? So we're able to pay off our acquisition loan and we're able to pay off our investors. And we get net refi proceeds of $300,000. Now, remember, this was back in COVID, 4.5% interest rates. You're not really going to see that right now. And a good way to understand where your interest rates are and what you'll get with permanent financing, and this is something to write down. Permanent financing is the 10-year treasury plus 1.5% to 1.75%. So if you go on Google and you look up the 10-year treasury, last time I looked today, it was like 4.093%, something around there. So let's say let's just to keep it simple, it was 4.00. So I know financing, my interest rates are going to be around 5.5% to 5.75%. So that's all the 10-year treasury. Commercial real estate is all about the 10-year treasury. So that's one of the most important things you guys should always be looking at is the 10-year treasury. But let me go back to this real quick. So 75% gave us 20.7 million. So we're able to pay off our acquisition loan and private investors. We get net refi proceeds of 300,000. So that's and net free cash flow around 400,000 almost. And we have remaining equity of 6.9 million because that's the difference, right? So on a high level,
I'm sorry, Isaac. Net refi proceed 300,000. Can you explain that, please?
Yeah. So net refi proceeds. So net refi proceeds is when you refi on your deal, it's that difference. And that's tax-free, people. That is also huge about real estate. When you are getting net free proceeds, net refi proceeds, that's tax-free. So where you get that number, right? So we got 20.7 million at 75% of 27.6. So we have 20.7 and we're all in for 20.1. So the difference is around 300,000 because after we pay off our acquisition loan, our private lenders, that's
yeah. So you clear out your all-in to include the private investors, the previous bank loan and everything, and stays in your pocket with another 300,000 free of tax.
Free of tax. Yeah. And then after that, you have cash flow of around $400,000 and you hold around 6.9 million in equity. Now, remember, though, with commercial real estate, depending how you finance it and structure it, the investors hold equity in the deal. That's how we like to do it. We like to give them preferred return, which is interest on their money, plus equity. So let's say they gave me $100,000. I'm able to pay them back off, but they still hold on to equity. So depending on the equity they own, they get a piece of that 300,000 and they get a piece of that cash flow as well as the equity. But the equity obviously stays in the building. Sorry, say that again. I didn't hear.
You didn't buy them out, meaning you didn't just told them, hey, take your principal, take whatever interest I promised you, and I'm going to stay with the property?
You can do that. You can totally structure it that way. I prefer to structure it where they hold equity in the deal. It just makes it juicier for them. That's how I do it. Sometimes, depending on the property, you could just be like, hey, I'm going to give you a crazy preferred return plus a kicker at the end once we refinance and I get all your money back. But that's it. You're out of the deal and it's mine.
Yes. After the refinance, they were out of the deal, like you just bought them out?
You could structure it like that, but no, I basically just return all their capital. So if they gave me $100,000, I gave them interest on their money of 10%. And I'll go over that. I even have it structured at the end of the presentation. But basically, how I structure it, I give them 10% preferred return on their money. So if they gave me 100,000, that's 10,000 year one, 10,000 year two, 10,000 in year three. Let's say I refinance in 4 years, right? I refinance, I give them back all their money. So if they gave me 100,000, their 100,000 is coming back to them, plus any proceeds because I give them equity. So if they gave me 100,000, maybe I give them 0.5% equity, 0.7, 1%, 2%, depending on how much I want to give and what we're structuring it at. So that's how I do it. Some people, they much rather prefer to have no one in the deal and just give them really good interest on their money. It's like, hey, in 4 years, you're going to get a 20% cash on cash or a 11%, 12%, and then you're going to get a kicker on top of that to add it once we hit our pro forma. So you could do that, and then you just own the deal outright. I've seen that a lot, and you could still do that. But we like to do a little bit of both. We like to do that option, but we also like to give them equity in the deal as well.
What is the purpose with this multifamily? You're about to sell it again, or you're about to hold it forever?
Probably sell it. So how we like to do our business model is we like to stabilize it in 4 years, refinance at year 4, and then hold and sell it in 10 years. But
the investors will be part of the deal for the whole 10 years.
Yep. And if let's say I refinance it in 10 years, they still own the property, they'll get their refi proceeds, and let's say I hold it for another 10 years. They're in it as long as I'm in it. But that's up to you if you want to give them equity. I like to do that because then, I mean, everyone's different. I like to do that. It helps other people. Let's say there's busy professionals. They can't invest in real estate. So what they would do, they would partner with us and we would own the property together. But obviously they're 100% passive. They're silent investors. They're called limited partners, LPs. And all they do is give the money and get the returns. They don't have to do anything with the property. I do that. So I give them equity. Now every deal is different. Maybe in 4 years I sell it. Oh, so then they get their proceeds. Maybe in 10 years I refi, like I was saying. So it really just depends. And then usually when you usually when you sell it, you'll 1031 it into another project or another property, and usually your investors will come and follow you.
What cap rate did you purchase this multi?
This one, I mean, let's do the math, right? So the NOI was 644,024, right? Oh no, sorry, I jipped that. So then I divided by the purchase price, which was 16,300 times 100. So this was a super low, but obviously the numbers still worked. But it's around.
What was the cap rate?
It's around 4. It's around 4.
Around 4, but you purchased it in an interest rate of 3.5.
Yeah, 4 point. Yeah.
So that what made it make sense because
exactly right now never.
Yeah, because if it was in nowadays, you cannot purchase in 4% and take a loan of 7 or 8%. It
No,
will be a negative cash flow.
absolutely. And banks wouldn't do that. They wouldn't even finance for you. That's 100%
Yeah.
right.
Yeah,
Today,
you came on the right time, at the right place, the right interest rate. That's why
exactly.
that's why it's structured so perfectly. Okay, looks
And
good.
and now today, and that's a great point, Michael. And today it is totally different. So it is harder. We're even seeing that it's harder to find these deals that are penciling out because people want these lower cap rates and the interest rates are higher. It doesn't make sense. And people are still living in 2020 where they're like, hey, I could sell it for 4 cap. I could sell it for this. But it's like, but not today. Back then, yes, so a lot of sellers are still in that mindset. But that's a great is real estate's all about the numbers. If the numbers make sense, it works. But you have to be able because who knows, interest rates can jump up again and you can screw yourself. So you guys got to be very careful with that. Any other things before I move on? And I'm going to talk about this specific deal. I'm going to come back to it and just talk to you guys about how we split it up with our investors. So you guys can also get an idea of that as well. I wanted to kind of show you a little bit of everything in an order. So did all of this make sense?
Yeah.
Awesome. So like I was saying though, with commercial real estate, everything takes time. I'm not making any money until 4 years in that deal. So why would I do it? Like, what's the purpose of doing commercial real estate if you know you're not getting paid in 10 years from now? So that's the thing with commercial real estate. Everything takes time. However, there are ways as an investor you can make money as like the operator. There's something called an acquisition fee. So the acquisition fee is once you do all the work, you source a deal, you underwrite it, you buy it. Once you buy it, you get paid for setting and doing it all up. And that's called an acquisition fee. So an acquisition fee can be anywhere from 1 to 5% of the purchase price. Right? So like what we were doing here. So the acquisition fee for this deal, we bought it for 16.3. $300,000 came to us when we purchased it, right? So, but usually it's around 3 to 3.5% of the purchase price. So that's the way you guys get paid, right when you buy.
This money is coming from the investors.
The entire deal, yes. You structure it in your way. That's part of your all-in cost. So
you have an immediate profit in the day of closing.
Exactly. Because you got to get paid. You got to make money doing this. You can't make a living when it's 3-4 years in advance. And investors know this. Everyone knows. It's very industry standard. Then you have what's called an asset management fee. So because you're an active operator, you're managing the asset. So like a property management fee, you take an asset management fee. Now, you don't have to do that. You can do it. It's usually around 1 to 5%. But people will do it for around 2 to 3%. So just like a property management, whatever the revenue you're making, you take a percentage of that. So if I'm revenuing, if like our gross revenue is 3 million, I can get 1 to 3% of that. And then it's the same with property management fee. Now, if you're not fully integrated and you have your own property management fee or you're not the one managing the property, you're not going to get that fee. That goes to a third party, the property management. And they take around 3 to 10%. With bigger deals, it's around 3. With smaller deals, it's around 6 to 10%. And then obviously, you get paid at refi. When you refinance, you get paid when you sell, and you get paid at cash flow. But cash flow is usually a little smaller in these bigger deals, depending how you can work it out. So that's also really awesome. You get money right off the bat once you sell it. And then as you're doing asset management fee, you take a percentage as well. So now I want to kind of jump into, we talked a lot about multifamily and residential. So I want to also show you guys the difference between office, retail, and industrial as well, because that's a total different beast of its own. So just like residential, rent is market based. So also in residential, you know how you're based on your comps. So when it comes to commercial, your rent is also based on the market rent. So for instance, if you know you're in this area and everyone's getting rents around $500, you could go more. You could go 1,000, but it's going to be harder for you to actually absorb and get people to actually come into your net because they're going to look around and they're like, hey, I can get 500. Why should I go? So it's really important to understand your market rent. With office, retail, and industrial, you charge rent by the square foot. So an example of that, and this is like kind of, we're building one right now that's 30,000 rentable square feet. So this is kind of just like an example of what we should expect. So if we have 30,000 rentable square feet at $22 per square foot, because that's what the market is right now, it's around 22 to 25, but we're being conservative. That's around $660,000 per year. That's around 55K per month. You charge per square foot, and this is super important to understand. If you're going to get into this space and someone's like, hey, it's $22 per square foot, that is not per month. That is per year. So just understand that. Don't think you're getting 660K a month. You're not. It's per year. So that you need to understand that. And there is a difference between total square feet and rentable square feet. So let's say you have a shopping center and it has a common area, or a business. You have an office space and there's common areas and there's just the office. That is not rentable square foot. So you can't make money off of that. So it's really important to know your rentable square feet. Then there's also different types of tenants and rental types. You have single net, you have double net, and you have triple net. And I'm going to go deeper into these because this is crazy. And then there's also different types of leases compared to residential, right? Like what we were saying, you're usually doing it with businesses. So the long-term leases, they're long-term leases around 5 to 30 plus years. So they're more predictable on cash flow. And because they're longer leases, you can have in the lease the rent raise increments. So you can have it every year you're raising a rent by 1%, 5%, 10%, or every other year. So every 2 years, your rent's going to bump up at 3%, or every 5 years. So it really depends on how you want to structure that. So now I want to talk about what I was talking about, the single tenant and all that. So first, because the tenants are businesses, and this is something to know if you're going to get into this space. So it is longer leases. So usually there's consensus. So you're going to offer 3 months of rent to the beginning or at renewal because, they're long term. You want them. So it's like, hey, if you can sign a 10-year lease with me, I'll give you 2 months free rent. Or if you renew with me, you've been with me for 10 years, how about I give you a few months rent for free? So that's something you guys can think about. And then also, especially in the office space or multi-retail space, you do usually pay a commission to a broker for an individual tenant. And it can also be paid at renewals as well. So obviously, if you're going to find a tenant or a business for yourself, you don't pay that. But if you have like a business, like an office center, and you have multiple offices, it's gonna be like just like finding an apartment building in New York. You're gonna have a broker who's gonna find you apartments, and once you find it, you pay them. So it's the same with businesses as well.
Do
So
you
that's
prefer
something.
to mix it like residential and commercial in the same building, or you prefer that everything would be residential? What is easier to manage? What is easier to add value to? Because I don't see much of value add in commercial. Like, correct me if I'm wrong.
No, you're absolutely correct. So with commercial, especially when you're talking office, retail, and industrial, there's not that much.
Starbucks will pay you 10 or 10, 20% each year more.
Not each year. No, 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 no. Because But there, like you said, it's not that much upside. It's just more predictable, and it's more what they call mailbox money. It's very passive. That's the beauty of it. But to get that upside, that value add, mm, less of in those units.
To have in order to make value add. That's what you're saying.
Yeah, could you repeat that? I didn't hear
Like
everything.
I guess like if I'm going to have a commercial building and I'm going to find out like Starbucks, I don't know,
Yeah.
Publix, and this big commercial, big industry players, like they're going to pay you 10 or 20 or 30% each more, each year more in order to have this value add, because part of the value add is to lower the expenses, but also to increase the rent. These triple A tenants, let's call them tenants, or industrial businesses, they're going to pay you more each year. That will eventually make the building have the value add that you desire.
So yes, but because like we were saying, they're longer leases, the concession you give concessions. So you offer free months, and maybe if let's say they have a 10-year lease or a 30-year lease, you're not going to raise rent every year. They're not going to sign that. You might want to be like, okay, every 5 years we're going to raise rent 5%. So it's still not the craziest value, but okay, every 5 years it's going to go up, or every 3 years, or you could go lower. It's like, okay, every year it's 1% or 0.5%. But usually with the longer leases, you work something out with them because you got to make it make sense for them, right? And what's cool about these tenants, and I'm going to get into it as well, is the different nets. So with commercial real estate, you're not getting that crazy value, but it's more predictable cash flow, and there's not that much value extra you're going to add to it. But, and I'm going to explain these different tenants because this is why people would be intrigued to it. It's a total different business model. If you're looking for appreciation and to get that value, it's less. But if you're looking, hey, I have money, I just want passive income, I don't want to worry too much, this would be a huge play. And it's good to diversify your portfolio, right? So a single net tenant, if you ever hear single net, that's only where the tenant pays rent. Maybe their share of property taxes. Double net is a tenant pays rent plus taxes and insurance, like their fair share, obviously. But so it's very common in office and shopping centers where owners maintain the common area, right? And then there's what's called triple net. And this is where tenants pay for everything: rent, taxes, insurance, maintenance. So let's say, so like repairs, utilities, upkeep, common area maintenance, everything. Let's say a window breaks. They go ahead and fix it. And they spend their money to fix it. Let's say the flooring it cracks a little. They'll go ahead and fix that. There's a leak or something. They'll go and fix it. However, the owner is in charge of the structure element. So roof, foundation, exterior walls, parking lot. That's the owners. So this is very common in single tenant rent, retail, and industrial properties. This is the most passive you can get in any real estate deal. Real estate, everyone here is passive. Real estate is passive, but it's not what everyone thinks. Oh, I'm going to be 100% passive. I'm going to buy a single family home and never look at it and touch it. Money's just coming in. That's not true. Michael, I know he's going to tell you that. You do a lot of work.
You need to work in your business. There is no, it's passive regarding the money that you're getting after you invested it, but it's not 100% passive. You need to work into it. There is a turnaround. Tenants are moving in and out, renovation, sometimes repairs. You need to deal with tenants that can pay, cannot pay. It's a work.
100%. Exactly. So, and I'm not trying to discourage anyone, but that's a reality. It's not, real estate isn't 100% passive. There are passive ways to do it, even with multifamily. That is not passive. It's a lot of work. However, with triple net leases, that is almost 100% passive. And it is crazy. You literally, the tenant does everything. So, like for instance, like Michael was saying, let's say you have a corner spot on a main road and Starbucks own it, and you have a 10-year lease with them. All you do is get the money. They will pay for everything. But let's say the roof caves in, or the foundation is messed up, or something with the exterior walls. That's where you have to come in. But it really is the most passive you're going to get with real estate investing. The only other way you can be 100% passive is being a limited partner, an LP on a deal, like I was explaining. You know how I raised 5.3 in that for that 296 unit? I had limited partners. Those people are 100% passive, but they rely on me to do all the work. So even though they're passive, I'm obviously doing the work and own the majority of the property. But that is the most passive you're ever going to get in real estate, is being a limited partner or triple net. And triple net's not 100% passive, but it is crazy. So if you're ever getting into that space and you know, hey, I just want predictable, good cash flow, long for the next 30 years, find a triple net lease, industrial spot, or retail spot. You'll be golden. And that is just super, super powerful stuff. That is
Why somebody will go on triple net? Like why a tenant will go on triple net?
That's a great question. So these big corporations, Amazon, Starbucks, Target, they're making so much money and it's a business to them. They want to get everything done and fixed up. So they don't really care about these. A small repair is nothing to them. Oh, a window breaks. Okay, let me just go. It's a lot easier for them to just go up and fix it. And it's like theirs, but they don't own it. So they don't have to really care about the property too much, but it's their spot for the next 10 years. So they're going to treat it like it's their own. It's usually going to be these bigger corporations. You're not really going to find a lot of mom and pop retail people to be triple net. They're going to be more of the single net. You know, they're mom and pops. They're just looking to pay rent like you would a tenant. These are more of these big corporations that just have so much money. They rather just be on top of it and fix it up themselves instead of having call you, get someone over there, check it out, fix it. They just much rather go for it. So that's why people will go triple net. It's extremely powerful. Any other questions about triple net, double net, single net, different types of tenants before I move on? Awesome. So we're going to go back and we're going to talk about the partnerships. Investors, by yourself. So you have different types of partnerships. You have a solo partnership where you just buy it yourself. You own it 100% outright. You have no one else. Works. Then there's what's called a joint venture, JV partnership. Let's say Michael and I, we come together. We want to build up. We want to partner on a deal together. So we would come in equally, work on it equally, and that'll be it. Sometimes you can work out a JV partnership where one does less, one does more, the splits of the equity, but it's usually a 50-50. Hey, you're bringing a lot to the table. I'm bringing a lot to the table. Let's work together. Let's deal. Just you and I. Then there's what's called the general partner and limited partner, GP, LP partnership. So this is kind of like what we do. This is how we've been doing it. And what it is the general partners are the active operators. We source the deal, we underwrite it, we manage, we refinance, we do everything that has to do, we renovate it, we do everything to manage the building, while the limited partners are just coming in and they're 100%. They're just investing in the building and that's it. They're quiet. They're silent partners and that is 100% passive for them. So people who are really busy, doctors, lawyers, salespeople even, they're very busy, but they make a lot of income and they want to diversify their investment. This would be a great opportunity for them. It's like, hey, they go and invest it with you, an active, real estate expert, an operator, and they know, okay, I'm going to own a piece of this deal, but I'm 100% passive. So that's another partnership. And then there's something called a fund. So a fund is very cool and unique, but it involves a lot of paperwork, legal stuff. It gets a little complicated, but it's very nice. What you do, you raise money into your fund, and it's like the GP-LP split, but instead, let's say I'm doing a $50 million fund. So I'm raising $50 million. It goes into that fund. In that fund, it's written out, hey, we're going to invest in value add multifamily, 80% in value add multifamily, 20% development for single family homes. So you could do that. And what's great about that, you have the money, so you don't have to go and raise it per deal. Like for instance, with the GP LP split, I find the property, the 296 units, we close on it. Now I have to go raise the money to go acquire it and actually do everything for it. Well, with the fund, you already have that money and you could be a little more on the negotiation side. Say, hey, I have the cash. You can kind of work it out. Does that make any sense about like the different types of partnerships there and how people would utilize it?
It's more towards they're more into it, but yeah, in general, I did understand. If somebody has more questions, he's welcome to open his mic and ask, because this information is very, very important. And thank you for sharing
Of course,
all of it with us.
this is very high level, and now I want to go and talk about how I do my equity split for you guys. I know I shot a lot at you guys. Michael told me not to hold back, so I wanted to do as much as I can for you.
That's a hardcore real estate. That's how it's structured, and it doesn't matter if you're going to be the next entrepreneur or you want to be part of a fund or a LP. It's better to understand the structure of the entities or the friends that into it in order to understand what you get into.
Now, Michael just said a super important piece. If, let's say, you want to be a limited partner, or you want to invest in a fund, you need to know everything that you're doing that when you're investing. You need to know who the GPs are, what's their track record, what have they done, what is the outline, what are my returns going to look like, what's their business plan. You need to know everything. So it's super important. And it's also important to know because when you get into the commercial real estate world, you're going to hear a lot of GP, LP, JV, fund. And it's good to understand that as well. It's like, okay, what does that mean? IRR, cash on cash, equity multiple. So I want to just show you how we kind of structure it. Now, this was back for that 296 unit right here. This exact one. So you know how I said we had 20.7 million. We were able to pay off acquisition loan, private investors. We had net free proceeds of 300,000. We had net free cash flow of around 400,000, and we have remaining equity of 6.9. Okay. So then let's say an investor gave me $100,000 for that deal. So we were offering a fixed preferred return of 10%. Now that can change depending on what you want to do. It could be 8%, it could be 12%, 15%, but usually it's around 8 to 12%, 10 kind of 8 to 10%. So for this deal, we were offering 10%. So that's just basically interest on your money. So that's 10% of the $100,000 you gave us. So you earn $10,000 in interest per year. So that's 10,000 year one, 10,000 year two, 10,000 year three. And because it was only 3.5 years, you get 5% or $5,000 because it's half of year four. So if we went to the full 4 years, it would be 10%. Then we offered
in offer to offer 10%, the property should have like at least 12-13% in return, right?
Yeah, so you also yes. So to offer that, you need so this actually okay, this is super high level. So you need to know the property's at least going to make some type of money. You need to know it has some percentage so you can pay off. But remember, with value add, a lot of times you're going to bleed the first year. And when you bleed, that means you're losing money. You're in a negative. So what you might have to do is actually raise more so you can pay off your preferred return. That is super high level, guys. So let's say I know, because you got to run all your numbers. So it's like, I know first year, I'm not going to make enough to even pay off my investors, 10%. So I have to raise more just to be able to pay them. that 10% preferred return. You're basically just giving them back their money.
The money that they provided to the deal, because in most structures, what I saw that in the first year, nobody is getting nothing. Not the investors, not the entrepreneur, nobody's getting nothing until we're going to stabilize it in the second year. So if you raise more, you're paying them back from what you raised?
Yeah. Yeah, no, exactly. Yes. Just so, because I want a structure where they're getting paid 10% every single year. I don't want it in the first year they're not making money.
So what happened in the first year? You're losing money. Let's say the vacancy is up to 60, 70% because most of them left after you announced that you're going to raise rent, and you're bleeding money, as you said, and the deal is not making nothing. How they are getting the 10% in the first year?
Because I predicted that, right? So that is something, because I have to know, okay, I'm going to bleed X amount in year one. So I want to know what the difference is that I need so I can pay out my investors 10%. Because as the general partner, as the active operator, I need to make sure my investors get that 10%. So as the investor, you're usually getting paid last. As the active operator, you are not getting paid nothing. That's why you get paid the acquisition fee at the beginning.
Where the money is coming from in the first year? Where the money is coming from? Like the building is not producing nothing. So where the money is coming from in the first year? How they are getting the 10% in the first year?
Well, that's what I'm saying. So you have to raise for that. You have to raise that extra money. If now you don't want to get in a deal where you're bleeding a crazy amount, then the deal doesn't make sense. You want to make sure you're bleeding, but not like too crazy. That's when you're looking at your underwriting and you're going through and you're looking at the deal, you're seeing how distressed it is, how we have to go in and operate this. You can kind of understand, okay, we can fix up this many units. We can kind of calculate how we're gonna attack that. But we know, hey, I'm gonna be bleeding $50,000 in year one. So in the entire year, I'm gonna lose $50,000. So I know I need to make more. Like I need to raise that if I know I'm not gonna make it from the cash flow that I'm bringing in. So that is something you have to think about if you're gonna offer this, because we offer a 10% preferred return fixed. So I want to make sure they get that. So if that means I have to raise more just to be able to pay them their preferred return, I have to do that. And it just makes it, that just gives them that 10%. It's super high level. Say that again. Say that again. Sorry.
I'm asking, are they getting like interest, or they are getting preferred return that is related to what the building is performing? Because if the building is not performing nothing, like, correct me if I'm wrong, it's not really a yield. It's not like a investment return. It's like some type of interest return, like they gave me a loan.
Yes. So yeah. Sorry. So that is what the preferred return, the fixed preferred return, is just another way of just saying interest on their money until
So
I
interest out of the money. Okay, because that makes a big difference, because interest on the money can come from any type of source. It can come out of my pocket or from another loan that I took, but interest on a loan is something that you can promise, because if the building is bleeding money in the first year, you cannot promise them a return on their money because the building is not performing, not it is losing.
Yes, correct. 100%. And I
So
apologize.
interest, so you're promising them some type of interest. Give me a loan in 7%, and this is the return, or 10%. This is what I'm going to pay you back out of my pocket, or out of the, I don't know, any other source of money that will give you back the 10% that I promised you. Regarding the interest, I promised you, not the yield that the building is performing, because nothing is being performed in the first year.
Exactly. 100%. That was perfectly worded. That is exactly what we're doing. We call it preferred return because on paper, I mean, this is just like a whole your legal team will do it when you're doing that, like doing a raise with capital. It's just another way so they don't get taxed so much, but it's basically interest. You're getting interest on their money. So exactly, doesn't matter how the deal is performing. I'm offering 10% interest, preferred return of 10% on their money. So if they give me 200,000, it's 20,000. If they give me 100,000, it's 10,000. So that's what I'm offering. And then on top of that, I'm offering equity. So for this specific deal, for every $100,000 you gave us, you're getting 0.7% equity in the deal. So you're getting 0.7% of refi proceeds. So out of that 300,000, that's $2,100 of cash out refi proceeds, which is tax free. And then, because remember, it's a value add deal. So it's going to be bleeding in the first few years, like the first year. Then towards the end, right before you refinance, it's stabilized. So in months 30 to 42, you can predict cash flow. It's already stabilized. So you're able to offer them 0.7% of the cash flow, which would come out to around $1,700 in months 30 to 42. So that's where Michael was getting at. If the property doesn't perform, they don't get anything. But I'm offering interest, so they do get something out of it. And then once the building, my property starts performing again, and there's cash flow where I can distribute it, then they also get cash flow. And then on top of that, they get to hold on to $48,300 in equity at refinance because they own equity in the deal. So once I refinance, we have that $6.9 million in equity. So they own 0.7% of that, which is $48,300, which also increases annually with principal pay down. So as I'm paying down the loan, obviously the loan's getting less, so you can build more equity. So that's really cool. And then once you refi, they own $2,700 per year in cash flow for the life of the building. So I'm going to break that down a little. So what that looks like, it's $35,000 preferred return. That's at 10% interest, plus $2,100 in cash out refi proceeds, plus the $1,700 in cash flow from months 30 to 42. So that's $38,800 in total return on investment in 42 months. So that's around 11% cash on cash. Plus they get $48,300 in equity retained. So that's a total of $87,000 total return in 42 months out of a $100,000 investment. So that's around a 24.9% annualized ROI. And that's after principal payback. So once I refinance, they got their 10% preferred return, they got their cash flow, I refinance, they get their $100,000 back that they invested, and they get to hold on to equity. So they hold $48,300 in the deal, which also increases as we're paying down the loan, and they're getting cash flow throughout the life of the building. Does that make sense? Is there any questions about how we structure?
It does make sense. What is the IRR, projected IRR?
So you're around that 20 to 24%. That's technically what the IRR is 24.9.
When you are cash out refinance it, or what projected sale will be?
I'm sorry, you broke out there. I didn't hear you.
I'm asking, are you calculating the IRR regarding the price in day of refinancing or the price of the projected sale price?
No, so I do it at the exit where I can return them their money back.
So sale price in day of cash out refi.
Yes, exactly. So whatever the returns will be at refi. So let's say I sell it, I would do it at that. But it's whenever I either refinance or sell it, that's how much I'm calculating my IRR. I'm not going more than that.
Makes sense.
So that's how we structure our deals. And that's what it would look like for an investor who would want to partner on our deal for that specific deal, right? So that's what it looked like for them. This is exactly how we presented it as well. And it's pretty good.
Another question.
Yes.
Another question. In nowadays, when the commercial interest, as far as I surged in the last time, is going to be between 7 to 9%. So in order for me, for us, for everyone that is listening, to find a good deal, like you have, like my rule of thumb is like try to find a deal that is at least 50% more than the interest rate I'm going to get when I'm trying to purchase it. Meaning if I'm going to get 8%, I would try to find a multifamily that knows how to give me 12% in cap rate. Does that make sense?
Yeah, no, and 100%, and that's very true. And that's a problem we've been having in the multifamily and commercial space right now is a lot of deals are not penciling because just rates are too high and people want too much money for it. So nothing's really penciling. It's been hard for us to find a deal. Now, does it mean that deals are not out there? No, deals are out there. Because also think about it, guys. The interest rates are the same they were back in 2012. It's not like they're crazy. It goes up and down. That's how interest rates are. So it's kind of where we're at back in 2012. So just understand that and don't be too bullish or aggressive when you're doing your underwriting. Like Michael was saying, you want to be conservative and understand your X amount over because you want to be safe. Because like what he was saying, interest rates can go up and they can go down. We hope they go down, but you want to make sure you're safe. So just in case they go up, you're not screwed. What I like to do, for instance, if we talk about this, when I'm looking to invest in a commercial real estate property, I want to make sure when I'm acquiring or I'm buying an asset, I want to be 70 to 75% all in to my future valuation. So in here, this was a perfect example. I was all in 20.1 million. So I know that 20.1 million is going to be when I'm projecting. It needs to make sense that my all in, the 20.1 million, is going to be 70 to 75% of my future value, which was 20.7. If that works, that's a deal. And a lot of deals are not penciling right now with that. But that is something I always look like. So I want to make sure my purchase price, my renovation budget, my soft costs, my acquisition fee, legal, all my cost when I buy this is going to be 70% to 75% of whatever my future value it is. That's also how you can tell if a deal is going to be good or not. That's how I do it. So it worked out here. We saw our all-in was 20.1 and 75% of my future value of what I'm going to get or projected to get, it works. It's under. So I like to be exactly there.
Because the interest rate 4.5 are lower than the cap rate that this building were valuated in.
Yes.
That's why it's cash flowing.
Exactly.
Because if the interest rate were 8% or 9%, you will fall into a negative cash flow and a lot of problem with your investors.
Yes, exactly. Yeah, no, that's why interest rate, guys, is super important. And that's why you got to look at the 10-year treasury and add that 1.5% to 1.75. That Michael makes a great point. You guys got to listen there because if the interest rate is higher than the cap rate, it's not going to pencil. You're going to bleed and your investors are going to hate you. And they're not going to want to go in a deal with you again. So you got to make sure, and that's why you also got to be conservative with the cap rate. You got to understand where you're going to be at, but you always want to underwrite that, okay, when I go and refinance or sell, my cap rate's going to be higher than what I bought it at for, not lower. Because what Michael just said, let's say interest rates are higher now, and you were underwriting that you were going to get it at a lower cap rate. It's not going to pencil. So just be very, very conservative, guys, because you don't want to fall into these traps. Now, just some risk mitigation, that's one. That is probably the most important. Michael just hit it there. Other things you guys should look for is location and market. So real estate is very hyper local. A good property in a weak market will underperform every single time. So you want to focus on job growth, population growth, income trends like high median income with low crime. You want to choose landlord-friendly and business-friendly states. You want to analyze supply versus demand. Are more units being built than being absorbed? Like meaning are more buildings being built than they are being rented out? That's super important to know. And then you want to follow the jobs. Wherever they drive the housing and tenant demand. So if you know, okay, a big Fortune 500 company just moved into the city that you're looking to invest in, that's good because it's going to bring jobs, and people are going to want to rent or buy. And then another thing to look into is your tenant and lease structure. Your tenants are your income stream. So a poor tenant is unstable cash flow. So you want to evaluate the tenant credit worthiness and lease duration, and diversify a little. Avoid over reliance on one tenant, unless they're especially for commercial. Now I can't speak about residential, but especially in commercial real estate, if they're an investment or institutional grade, that triple A plus plus tenant, it's okay to keep them. Like, you don't need to diversify from that because they're usually more stable. And then you want to review the lease terms, renewal option, rent escalation, maintenance obligation. Is it a triple net? Is it a single net? What is that? Super important to understand every detail of your business. You want to understand the tenant improvement obligation, who pays what. Like, for instance, a 10-year lease with a national credit tenant like Starbucks is very different from a 1-year lease with a local startup. So just understand that, guys. It's super important to understand every aspect of your business. The numbers are so important. Get good at the numbers. You see, Michael is very good with the numbers. That makes him a great investor. Now, sometimes the numbers just don't work. Don't get married to a deal. This is business, guys. This is not don't get emotional. If it doesn't work out, don't kill yourself. Oh, I really love this market in this specific building. I love it, I love it, I love it. But the numbers don't work. Forget it. Move on. Find the next piece. Don't get hooked onto it. And that's basically wrapping it up. If you guys have any other questions, please, this would be the time. If you want to contact me, this is my cell. I use WhatsApp, so the +1 if you're in Israel. That's my email, website. So if you want, screenshot it, hit me up. If you would like to speak more, I'm more than happy to talk to you guys. Maybe there's opportunities in the future. I'm always looking to meet new people, make new partners, and make things happen. Especially if you're one of Michael's guys, you're good with me.
Isaac, where are you located?
Yeah, great question. So I'm originally from Nashville, Tennessee, and I do a lot of my investments in the Tennessee, Southeast, and Midwest area. And I live in New York right now, so I bounce back and forth.
I see. It
was fascinating. Thank you for the information. For me, it was a big learning about how to structure and how to see a deal behind the scenes. And if you have in the future any deal that you want to raise money, you can contact me. We can go to another webinar, and obviously it will be a new case study and maybe a new opportunity for you to raise money from people that pay to learn real estate, want to invest in real estate. Most of them are already investing in real estate. And I hope it will be more professional groups like yours in the industry that work in a very transparent way. And investing in multifamily, this is my next challenge. And thank you for the information. It was really fascinating, and I learned new things by myself.
Thank you, Michael. I really appreciate the kind words. I thank you for this opportunity. If it really wasn't for you and your group and your students, I wouldn't be here. So I really appreciate that. And 100%. If in the next deal, I would love to reach out and let's see what we can do.
Let me know, and I will give you.
And maybe there's opportunities to even work together.
Yeah, why not? I'm open for everything. I would be happy to, if you have a new investment and you want to have another webinar and show us the numbers and the deal and raise money, and maybe on the way learn us new things, why you picked this type of a deal, how you structure it, how you're going to make it more profitable. So I would be glad to hear back from you. Obviously, it's going to be a recording in the course, so everyone can go back and listen and learn the behind the scene of this type of investments. and I will upload that also to my YouTube channel. I have almost 1,000 subscribers, and obviously it's going to be a new exposure for you. And I would be happy to push forward your business. I think you're a great guy, and we had a great conversation. And thank you for all the efforts that you put into this webinar. And I know that a lot of my students will gain a lot of new highlights about multifamily from this excellent webinar.
Thank you so much. And really, I really appreciate the kind words. This was amazing. This was a great group, guys. And really, that goes out to anyone in this webinar or in Michael's group. Please, you guys are more than welcome. You guys can reach out as well. And I would love to take you up on that offer, Michael. Next deal we have. Even if you want, we could even go over that previous deal and show you the pitch deck we had for our investors and for future deals as well. I can go over. We can set up a webinar for all your students. I can show you exactly what I'm presenting and how we got everything and do a little more back end for you and your investors and your investor group.
You can make part 2 of this webinar. Like this is part 1, like you're running it for how long? 4 or 5 years? So you can make it part 2 in 5 years. I'm going to call you back again and hey, let's do part 2. Let's see what happened.
We can definitely do that.
What happened with the investors and what is the final numbers of this deal? And we can follow this deal for the next few years. And I will be happy to have a part 2 for this one.
I would love that. And like I said, any other new deals that come our way, I would love to present it, and we can also do that case study.
Feel free to contact me.
Always, always. Thank you, guys. Thank you, everyone. Any other last questions before I hop off?
Okay, so guys, thank you, Boris. And thank you, guys, to everyone that joined in. And,
thank you, Isaac.
Thank you,
Isaac. A lot, and hopefully all of you, all of us.
Thank you, guys. Have a great rest of your week. Shavua Tov. It was great meeting you guys.
Thank you, Isaac.
Bye.
Bye-bye.